Hello. Today we're going to do something completely different. We're going to take a look at what happened with Silicon Valley Bank and whether Silicon Valley Bank is the canary in the coal mine. I know a lot of people are talking about Silicon Valley Bank and they're saying that the problems are their diversity focus. The problems are that they were involved in crypto. The problem is that they were involved with the tech bros. None of these, even though they may be valid criticisms, had anything to do with the collapse of Silicon Valley Bank, and the reason that the bank failed is a risk to the entire financial system, and I will explain why. A lot of people don't realize that as interest rates rise, the value of bonds and other assets go down. This chart explains why. Let's assume that you have a US government bond that is issued when interest rates are 2%. The bond has a face value of $1,000 and it is paying $20. That bond will pay $20 a year thereafter, no matter what interest rates do, and a $20 return on a $1,000 investment is a 2% return. Let's assume that interest rates move higher to 4%. That bond is still paying $20 a year, but investors comparing it to other bonds of a similar type are going to demand the same 4% return. Therefore, that $20 has to be a 4% return, and that is a 4% return on $500. If interest rates go from 2 to 4%, the value of the bond is cut in half. Similarly, if interest rates move lower to 1%, bond is still paying $20 a year, but now that only needs to be a 1% return. Therefore, that bond is now worth $2,000. So, what does this all have to do with what happened with Silicon Valley Bank? Well, the interesting thing is that Silicon Valley Bank did not go out of business because of bad loans, and it didn't go out of business because of losses on cryptocurrency or anything to do with the tech sector that it's primarily banking for. Silicon Valley Bank went out of business because they invested in US government bonds. I know that sounds crazy, but when you look at what interest rates have done, as I show you on this chart here, you can see that interest rates have done a lot more than doubling. They've gone from 0.398% in March of last year for the 10-year US government bond. Late last year, it was up to 4.33%, and today we are barely below 4%. So a dramatic increase in interest rates, and this has caused the value of all the bonds, all the government bonds, all the other bonds that are held by banks to lose value. Now, why hasn't this become a problem until now? Well, it's because after the '08 financial crisis, the Dodd-Frank Act was passed, and they tried to alleviate the problem of banks having to liquidate assets in a crisis, and they allowed banks to assume that if a bond or asset was being held to maturity, that it didn't have to be marked to market. Mark to market means it's value adjusted every financial statement. You could just hold the asset at the price that you paid for it with the stated intent to hold it to maturity and wouldn't have to recognize any gains or losses on it. Well, what that meant is that Silicon Valley Bank had a $15 billion unrealized loss in these government securities. Silicon Valley Bank only had equity of 16 billion. So when the market suddenly woke up all of a sudden and realized that these unrealized losses were actually making the bank technically insolvent, it started a run on the bank. People started withdrawing their deposits, and Silicon Valley Bank went under, second largest bank failure in US history. This problem is that Silicon Valley Bank is just representative of the banking system as a whole. If you compare Silicon Valley Bank to its peers, Silicon Valley Bank had $173 billion of deposits and only $74 billion of loans, which is 42%. They had $119 billion invested in US government securities, which is where the problem lies. On January 19, Silicon Valley Bank put out its annual report, and they disclosed that they had $15 billion in unrealized losses. The day before they issued this report, the stock was $250 a share. The day after they disclosed these $15 in unrealized losses, the stock rose to $291 a share. The market just ignored the facts that just a month later caused the bank to completely evaporate. Is it an isolated circumstance? Let's look at Wells Fargo. Wells Fargo has deposits of 1.38 trillion and their loans total $955 billion. So whereas Silicon Valley Bank was only loaning out 42% of their deposits, Wells Fargo's loaning out 70%. How does Wells Fargo stand in the unrealized losses department? Well, Wells is reporting $50 billion in unrealized losses. And if you look at this table right here, Bank America reports that they have $108 billion of unrealized losses. So Silicon Valley Bank is just the tip of the iceberg. As a matter of fact, the FDIC, which is the entity that insures all of these banks, they estimate that there are $650 billion of unrealized losses among US banks, and the Deposit Insurance Fund only has $128 billion of assets, which of course are invested in government securities. If you really want to get concerned, you could think about the Federal Reserve itself, which is not part of the government, but which is actually just a bank owned entity. The Federal Reserve has been buying bonds, as you know, for over a decade now with a lot of enthusiasm. They are sitting on unrealized losses of 330 billion. They've got 42 billion in capital. So the entire banking system might be exposed because of this problem. The Silicon Valley Bank exposure is the canary in the coal mine. It's warning us about exposure in the system altogether. All of these banks have unrealized losses on government bonds. Most of them have by far the majority of their assets in government bonds. Those that they haven't loaned out, hard to say which one is of greater risk to the balance sheet these days. But I certainly think that the Silicon Valley Bank story is a warning to us as to how fragile the banking system is. Keep in mind that just 1 month ago, Silicon Valley Bank was trading for almost $300 a share. And today, a month later, those shareholders are being completely wiped out. Now, the depositors are being made whole at taxpayer expense, of course, no matter what they tell you. But that's a story for another day. Take care.